U.S. inflation cools in January. Gas prices fall and markets find stability. In early 2026, fresh inflation data provided a mix of relief and caution for American consumers and investors alike. The latest Consumer Price Index (CPI) report for January 2026 showed that inflation slowed more than expected, while gasoline prices continued a downward trend that offered pockets of relief at the pump. Stock markets, shaken recently by tech-driven volatility, steadied after digesting the softer inflation figures. Inflation eases, though still above target. The Bureau of Labor Statistics reported that headline inflation rose 2.4% year-over-year in January, down from 2.7% in December and below many economists' expectations, marking the slowest annual increase since mid-2025. Monthly inflation also remained modest, with overall consumer prices increasing just 0.2%. Core inflation, which excludes volatile food and energy costs, rose 2.5% annually, the smallest gain since early 2021, suggesting broader price pressures may be weakening. Analysts see this moderation as a sign that the post-pandemic inflationary surge could be winding down. Despite the cool down, inflation remains above the Federal Reserve's 2% target, and certain everyday costs, such as food, housing, and services, are still rising. Shelter costs, for instance, continue to contribute significantly to the CPI, although at a slower pace than earlier in 2025. Gasoline prices provide consumer relief. One notable contributor to the inflation slowdown was energy. Gasoline prices fell 3.2% in January, and over the past year have dropped roughly 7.5%, offering tangible relief to American consumers who have felt the pinch at the pump. According to data from the U.S. Energy Information Administration and Federal Reserve, the average national gas price was about $2.90 per gallon in early February, down from $3.13 a year ago. This decline has helped slow overall energy inflation and ease pressure on household budgets. While gasoline and other fuels such as propane and fuel oil have softened, other energy categories, like utility gas service and electricity, have remained elevated, partly offsetting some of the benefits consumers experience at the pump. Wall Street reacts. Stocks stabilize after AI-linked sell-off. Financial markets had faced volatility earlier in the week, particularly in technology sectors hit by fears that artificial intelligence, AI, advancements could disrupt traditional business models. Large tech names fell sharply during the sell-off as investors reassessed risk across growth stocks. However, on February 13th, 2026, U.S. equities steadied after the softer inflation data helped calm Wall Street jitters. The S&P 500 remained mostly flat. The Dow Jones Industrial Average rose modestly, and the Nasdaq Composite saw minor declines. Easing Treasury yields and the prospect of future interest rate cuts boosted sentiment. Certain technology and logistics stocks that had been hit hardest by AI disruption fears began to recover somewhat, helping markets find footing after earlier losses. Economic outlook and policy implications. The January CPI report and falling gas prices have broader implications for policymakers and consumers. The Federal Reserve, which has held interest rates steady in recent months, may feel increasing confidence to consider future rate cuts if inflation continues its downward trajectory. At the same time, persistent price pressures in core components of the CPI, especially housing and services, mean that policymakers must balance inflation control with supporting economic growth. For households, lower gasoline costs offer immediate budgetary relief, even as everyday essentials remain costly. Investors, meanwhile, will continue watching inflation data closely, as it directly influences interest rate expectations and market valuations.